Hello everyone and welcome to your Glassnode video report for week 3, 2023. So it has been one of the more exciting weeks in some time, really since the FTX collapse, and thankfully we're actually heading in the opposite direction. So you can see that we've rallied back up to around 21,000 over the last week, which has more or less pulled us back into the previous trading range. And something that else is quite interesting is we're seeing a little bit of a shift in the overall profits being realized in the on-chain system. And there's a bit of nuance to this, and this is really what we're going to be exploring today. So with Bitcoin really waking up after one of the least volatile periods in history, we've seen an explosive move to the upside. We've pulled up to over 21,000. And what's really interesting about this particular rally is it broke above several key pricing models, which we'll explore today, that actually puts us, the average Bitcoin investor, back into a profit. So we're going to explore this from a couple of different angles because that may not initially make sense, especially if you've kind of weathered this bear market. You may say, well, how is everybody in profit? What we're looking at here is averages over the entire market. And we'll look at this from a number of different angles, both technical, both on-chain. We're going to look at it from the mining perspective, but we're also going to spend a bit of time looking at the realized profits from two different angles, which is a really, really important topic to pay attention to. And it's really an excellent set of tools to monitor as we look for a return back into some kind of market recovery. And naturally, if we don't see these models actually play out and these metrics actually fail to get any kind of upside momentum, then it would tell us the other side. It may tell us that we actually have a little bit more time down here and that maybe things aren't quite as rosy just yet. So as usual, please do give us a rate, a share, and a subscribe. It does help this channel get to more people. And do check out our video from Saturday this week where we covered a whole new suite of dashboards that are really designed to help you navigate your way out of a Bitcoin bear. So if you missed that, you will find a link in the description below and on the card for this video. Right, let's get started. Okay, so as I mentioned in the introduction, what we're looking at here is essentially a price chart. We can see we went all the way into this very, very quiet range. We spoke about this last week. It was about a $550 range for over a month. And then what we saw is an explosive move to the upside where we broke back above 21,000. And as we discussed last week, it is very, very rare for Bitcoin to go this quiet without preceding some kind of volatile move. And really the question was, are we going to be heading up or down at that point in time? Clearly, we've managed to get some upside momentum, which is a nice thing to see. But remember, we have to look at this in the broad scale context of where we are. So what we're going to do over these next price charts is just get a bit of a gauge on whether this is just another bear market rally, some of the things we can be paying attention to help us discern, does this actually have more legs than previous rallies? So we're going to spend a bit of time focusing on pricing models today. And just so you know, you will also find a link in the description below to a brand new pricing models dashboard where these metrics and several others are all going to be covered. So that's really focusing on those pricing models, fair value models, different tools that we can use to try and understand where Bitcoin is in the cycle. So the model we're looking at here is the Bitcoin Mayer multiple. Now, this is a technical model. It's just a very simple derivative of the 200-day moving average. So the blue curve that you can see here is the 200-day. And the reason why this is an important model is because through both Bitcoin and digital assets and traditional finance, the 200-day is an extremely widely observed model. It's typically used as a bull-bear litmus test. If below, probably bearish. If above, potentially bullish. So what we're looking at here is something that many, many traders are looking at. And when lots of people are looking at it, these things tend to become self-fulfilling prophecies. Now, really, since back here in December 2021, we have essentially traded below this 200-day moving average for I think it's about 381 days or thereabouts. Now, interestingly, back here in 2018 bear market, we spent 386 days. So we're talking about a 5-day difference. Bitcoin has this strange cyclicality where it just seems to repeat these patterns, whether people like it or not. Forgive me for becoming a bit of a 4-year cycle maximalist, but it certainly seems to be coming around where we see these patterns, these psychological behaviors, and this occurs all the way back before we even had TradingView price charts back in the 2013, 2014 era. So we've seen the 200-day. It's like a psychological level that many people respond to. Now, we saw back here in April 2019 a rally that pushed us above the 200-day, and that particular event actually managed to push us up from about 4,000, 5,000 up to 14,000 in a matter of a couple of months. Now, we then had a bear market that followed it, and which you can see when we broke below the 200-day, it essentially spelled the worst part of that 2019 bear. But then when we had the break back above, we essentially held it for the 2021 bull. Now, we have recently poked our head above the 200-day moving average, which is at 19,500. So again, this is one of those things where just the fact that we're above it is different to all of the previous attempts that we've had over the course of this bear market. In fact, there's only really been one prior attempt, and that was right before Luna collapsed. So that was the last time that we tested the 200 days. So at the very minimum, breaking above that 19.5 level just gives us a sign maybe we should pay a little bit more attention in the coming weeks. Now, naturally, a break back down below that would probably not be a great sign, especially if it's on a weekly closing basis or something similar. So it gives us a bit of a threshold to manage a bit of risk as well and just understand, is there actually a reversal? And this really is just a very short-term pump before we have some more pain ahead. Now, sitting only just above the 200-day moving average was the realized price. This one here was sitting about 19,700 at the time, and we have now broken above that as well. Now, we spent about 180 days below the realized price through this bear cycle, and that is now the second largest time that we've spent below it. The only one that beats that was back in the 2015 bear. We spent over a lot more than a year. I can't remember the exact number, but it was more than where we currently are, 300 and something days, I think. So this is the second worst bear market in terms of duration under the realized price. Now, because we're now above that level, we've kind of got two models, the 200-day and the realized price, sitting very close to each other. And that adds a bit more weight. If we happen to get below those again, probably a really bad sign. On the other hand, we're now going to see two of the most widely observed pricing models, the 200-day and in the Bitcoin world, the realized price. These are models that many people are aware of. They pay attention to them. For the realized price in particular, it's essentially the all-time cost basis of the all market. So we're looking at what is the average price at which every coin last moved. And because we're now above it, essentially the average Bitcoin holder is now back into an unrealized profit. So as I mentioned in the video on Saturday, typically speaking, when you're holding coins in a profit, it's just that little bit easier to hold. People generally don't like seeing too much red in their portfolio. It generally creates a sense of panic and people make decisions in a bit of a hurry. When people start to move back into a profit, it generally signifies a bit of a reversal of that. It's just that little bit easier. Human psychology just functions this way. So again, two models we can pay attention to and a bit of a pricing threshold as to where we don't really want to be trading too far below on any meaningful time frame. Now, sticking with realized prices, what we have here is a suite of realized price models. In the blue curve for our longer term investors, people have held their coins for over 6 months. The red curve here is one that you'll see for the shorter term holders. This is a curve that's actually mapping out holders who have held their coins for less than that 6-month period. And then we have our realized price. Now, in terms of similarities to our 2019 era, we broke above all three of those in one move. So it was a very, very quick rally, and then that triggered off this next move. Now, we've got through the realized price and the short-term holder realized price, but we have not yet breached the long-term holder realized price up here at 23,200. So we have some degree of similarity. Remember, things are never going to repeat exactly the same. But what we're starting to see is several of these models are saying that we're actually above some of the big cost bases. Now, what's actually quite important, let's zoom in on a 2-year basis here. What I want to note is the short-term holder cost basis. Note how it dives, particularly when price goes through these big sell-off events. The short-term holder cost basis dives down quite low. That is because we've seen a massive capitulation. That means of the coins that recently moved, lots of them were in the recent price action. So what we're seeing is a capitulation, and for every seller, there's a buyer. So when you get this massive diving of any of these cost bases, it's essentially a large-scale changing of hands. Coins have changed hands at a significant rate, and we've seen a massive amount of that occurring down here in this lower price range. Now, the other thing I want to highlight, let's just go back out to a 5-year chart. What we're looking at here, note during bull markets, all of these models tend to, particularly the heated bull, we see all these models separate. People who are short-term holders are following the price, they're trading, they're moving their coins around. Long-term holders are always much, much slower to respond. That's actually a lagging effect on top of the realized price because obviously the coins that were accumulated here will not become a long-term holder until they're 5-6 months later on. But what you can see is a big divergence. If you're a long-term holder, you have a different cost basis to the average market, which has a different cost basis to the recent buyers. Now, note during bear markets, particularly late-stage bear markets, all of these compress and become more or less the same. They're not really the exact same price, but they're within a very, very close range. Here we are with that exact same effect. The logic here is that it doesn't matter if you've held your coins for 6 months, 2 years, 5 weeks, 1 day. In general, the average cost basis of the market is pretty homogeneous. We essentially have a market that has reset. We've got a market of holders who are all more or less in the same financial position. And that really gives us a bit of a, if it's all the same market, we talk about how hodlers typically are the last guys standing. We're starting to get to that point in time where the hodlers are the last guys standing. And that's essentially what this compression of all these realized prices together is telling us. We have a homogeneous market. And once you have a homogeneous market, it means you can start to, it's almost like returning to a state of equilibrium, so to speak. So there's a couple of observations for this one. And by the way, this particular model is available for our advanced members as well. This is a set of models that we've built to try and capture that short and long-term holder behavior. As we've heard a lot of feedback that our advanced members are looking for something like this. And this also you will find inside the pricing model dashboard, along with a handful of other metrics that go alongside it, MVRVs and the like. Now, the topic of estimating Bitcoin's fair value. This is one of these things that there's been countless models and iterations. People have been trying to estimate what is Bitcoin worth, since it's been around. Now, there's a really interesting model that Willy Woo originally developed, which is called the NVT Price Model. Now, this particular model is trying to take transaction throughput, how much value is flowing through and settling on the chain, and then deriving a price model from it. Now we have two different variants here. The first one uses our change adjusted data for transaction volume, and the one on the right hand side uses our entity adjusted data. Now the reason why I'm showing both of these is if we actually zoom out on a 5-year time frame. Let's just leave it for this one here. For the change adjusted model, just note how both of the pink and green models, they're not too bad. They follow price for the most part. There's a bit of volatility, but note 2022. This giant bubble followed by this giant collapse. There's clearly something that diverged quite significantly in 2022. It was a bit of a funny year, and those of you who went through it, there's probably some indications as to why. Through this period, we had a huge amount of deleveraging. Lots and lots of coin volume was moving around to try and essentially save people's positions. We saw lots of large trading desks, large trading funds, and sadly, some of the mismanagement of wallets by one certain FTX and Alameda entity. And that really gave rise to this enormous bubble in transaction volume. So in theory, it was suggesting a price point for Bitcoin that was just simply much too high, but it was being driven by a lot of deleveraging, a lot of large transactions, a lot of pain, and unfortunately, a little bit of malfeasance. But what we can see is that this has now collapsed back down, and this model will take a little bit of time to actually reset. We've got a 28-day and a 90-day window here. So over the course of the next couple of months, this will start to re-equalize. It'll take a bit of time to actually smooth out that look-back data. However, if we then turn and look at our entity adjusted data, this is really trying to take out much of the self transactions and the internal wallet management. It's a much, much cleaner data set. And what you can see is that both of these models are currently estimating a Bitcoin price somewhere between about $15,000 and $17,500, which interestingly is pretty much where we traded over the course of December and the first half of January. So these models are essentially suggesting that we've broken through those fair value models. You could argue that means that it's potentially in an overvalued territory. However, what we tend to see with these rallies, and this is something to pay attention to, we need to see transaction volumes actually pick up. Does on-chain activity come back to life? Do people start to have a bit of an interest in Bitcoin again? If not, then maybe these models are correct and we're actually a little bit beyond that source of gravity. If, on the other hand, this rally motivates people and we see people coming back in, adoption starts to increase, transaction throughput increases, then perhaps these curves will actually start to follow price as they've done through previous bull markets. You can see here, 2019, the transaction volumes and the implied pricing followed the rally. We will see if this is what plays out here. But just an interesting snapshot showing the difference between these data and how there is, in fact, a bit of nuance when you come to actually analyzing these things. Now, one particular set of entities must be feeling just a little bit of relief, and that is the mining cohort. Now, the miners had a really difficult 2022. And the reason that we know this is that some of these are now publicly traded companies and their stock prices got walloped. So we can actually visibly see that there was stress in these mining industries, with some of the largest ones, Core Scientific, for example, actually going bankrupt. So a very, very difficult time for miners, a really challenging year, lots of debt, lots of leverage. And as bear markets tend to do, they flush that out. Now, with this rally, we managed to push back above the difficulty regression model. This one here is basically trying to estimate the average cost to mine. It's not looking at any particular miner, it's just relating difficulty and price and essentially establishing what is a fairly high correlation model, looking for what is the estimated average cost to produce Bitcoin. And it's currently sitting here at 18,800. So what we've seen is we've had a break above that level. So that's going to give us an indication that maybe miners are under just that little bit less stress, because the average miner may just happen to be mining at a little bit of a profit again. Now, we also have the difficulty per issuance, which is just another take on trying to estimate the average cost to mine. This one here uses three curves. The red one down the bottom here is looking at the most efficient miners, those who manage to survive at the bottom of bear markets. The purple one is the least efficient miners, which is basically a 2x of this, which otherwise means the red curve will be up here at this purple level if we had a halving today. So that's basically saying that if the issuance was cut by 2, the revenue is cut by 2 immediately, this is where the most efficient miners would be, and thus that is where we estimate the least efficient miners to be. And we then have the mean of those, and that's basically looking at the average miner. So very similarly, this one here is only just below the regression model at 17,600. We are now above that model as well. So what we can imply here, remember, we're not asking miners their opinion here. We're just looking at data, trying to estimate their cost of production, and then we're inferring that that potentially is going to reduce stress on miners. Now, to try and illustrate that point, this particular model is about ASIC Rig profitability, and we're looking specifically at the Antminer S19 Pro. Now, this rig was released back here in May 2021. And what we're looking at here is a series of different curves for an all-in sustaining price. If you're mining at 5 cents per kilowatt hour, 10 cents per kilowatt hour, 12.5 cents per kilowatt hour, each one of these is tracked in one of these different color charts. So we've inferred in the model above that we actually have miner stress, and we may have just relieved some of that. Now you can see here that this model, the purple curve, is the least efficient miners. These are at 12.5 cent per kilowatt hour pricing. You can see that that purple zone disappears. Shortly after this rig was released back here in May 2020, we had the halving event, and that rig was almost immediately, could not be operated profitably under 12.5 cents per kilowatt hour. So what we saw is that they basically immediately plunged into stress, and only those with a cheaper power price were actually able to sustain that rig. Now you can see here that we actually lost our green curve over the course of the last 6 months as well. And that's the 10 cent per kilowatt hour. So what we're really seeing is that whilst we were actually trading below these estimated cost of production levels, if we do a very, very simple model on how many rigs were actually profitable, we can see that unless they were operating with something like 7.5 cents per kilowatt hour, they actually weren't profitable at all. So this is just another model to essentially say, yes, we actually did have quite a bit of mining stress. And you may be able to see on the right-hand side here, the green has returned. So those miners who are operating at 10 cents per kilowatt hour, they are now able to use this rig, which is going to form a fairly large portion of the mining fleet. They are now able to mine without too much difficulty. So we're seeing that that profitability actually shows up across this model as well, which gives us that additional confidence. By the way, there is also a new dashboard on this rig, on ASIC rigs. It looks at power consumption. It looks at overall global hash rate, how many rigs we estimate are actually operating, profitability of various rigs. So I've seen some folks with some of these S9 miners inside a heater, you could actually use that dashboard to establish whether you would or would not be profitable. So just another set of tools we've released in our dashboard suite. Now, the last thing that I want to focus on is looking at network profitability. So when we talk about network profitability, we're looking at all of the coins that are moving around on any particular day and looking at what is the profit multiple or the dollar value that they are realizing in profit or loss. If you bought your coins at 50,000 and you sold them at 16,000, you're going to be realizing a loss, and vice versa. If you were buying back in the previous bear market at 6,000 and you were selling it at 60,000, you're going to be realizing a profit. We can measure when a coin was moved and look at the delta between acquisition and disposal. So there are two models here, and these are actually really, really powerful tools in almost all market conditions. And we will actually come back to these. We're going to explore this purely from a bear market recovery standpoint, but we can use these during many different market cycles. They're a very, very versatile tool. So we'll be covering these in more detail in future episodes. So on the left-hand side, we have the aSOPR model. So SOPR is looking at the profit multiple. Think about it on a per transaction basis. It doesn't care about whether you're a shrimp or a whale. It's not looking at coin volume. It's just looking at the price of acquisition, price of disposal, what was your profit multiple, and it takes an average across the whole market. Now, what we can see is that during bear markets, coming up and retesting this value of 1 is typically a point of resistance. This is basically saying that those who are spending their coins are getting out at their cost basis. The psychology here is just give me my money back. I hate this bear market. I just want my money back. I'll take a little bit of a loss. I'll take break even. Just get me out. So investors are essentially selling at their cost basis. That creates resistance. And then we have these big pullbacks. You can see that we typically get these retests of 1, and then we get some market weakness that follows. Here it is retesting 1, and then there's FTX blowing up. So it's kind of funny how these on-chain metrics, they tend to just, you can look at them alongside market events, but you can also look at them as this is the investor behavior that's going on under the surface, and it provides you with that extra edge. Now, you may have noted that here we are retesting 1. So we are in the process of trying to break above. Coins that are on the move at the moment are realizing a very slight profit. Now, the question is this actually going to break lower and be a failed retest? Or in the instance of previous bear markets, a clean break above, a retest of 1, and then a new bounce? What that indicates is a change of sentiment, a change of human behavior. If we get that significant retest, and you can see it back here in our September 2021 dip, we had this break above, pulled back, and then we had the bounce. This retest here is investors buying at their cost basis. It's a reversing of human behavior. Now, naturally, these things can then falter and then the market revolves. So it's never a single answer. It's always one of these things we're assessing them in context. But generally speaking, that is the human psychology that sits behind it. So we are clearly at a decision point. Is the market going to start taking that exit liquidity? Are they going to say, give me my money back and just get me out at or near my cost basis? This is a metric to pay attention to. A clean break above would be a good sign. A retest would be even better. And this one here is on a 7-day moving average. If you look at this on a 30-day or a longer time frame, it's obviously going to be slower. But when it actually happens and repeats that pattern, it generally has a much, much longer term trend. So the shorter your moving average, the more noise. The longer your moving average, the more confidence you'll have, but it will be slower. And this is typical of many metrics, not just in on-chain, but also technical analysis. Now, the realized profit loss ratio is the same concept, except instead of measuring shrimps and whales as the same, here it actually does care about coin volume. So you use it with exactly the same concept. The same models apply, where when you're in a regime where there's more profits than losses, it generally correlates with a bullish market. When you have more losses than profits, it generally correlates with a bear market, as you would expect. Now, we have seen the largest realized profits relative to losses really since back here in April 2022. So we have seen a significant break above. What we again need to see is that entry into that more profit dominated period of time. And this is another one of those metrics that if people are taking profits now and the market can push through it, it actually tells us something about demand. There's enough demand to come in to absorb people who are swing trading. They bought low and they're selling high. We're seeing there's enough demand to actually absorb that profit. If on the other hand, we break back down below that level and you start seeing losses dominate, you may be reinvigorating those top sellers who go, oh no, I missed my exit liquidity, and another round of sell side comes through. So this is another great model to be tracking to just understand where we are in that bull bear cycle and trying to understand if we return to a profit dominated regime or a loss dominated regime. Typically happens around cycle turning points. So thank you for tuning in for that session, folks. Hopefully you found that useful. What we've seen is a pretty impressive 23% rally from Bitcoin. We did get above 21,000 and we broke above several key pricing models. The market is generally back into a profit. Miners have seen some relief and we are starting to see some profits entering the system. What we need to really see now is we're at a decision point. Can the market actually hold on to it? Or do we start seeing this motivation of people saying, just get me my money back? I'll take whatever exit liquidity I can find. Does that actually create a new round of sellers? And now we've got a couple of tools that we can use to track that over coming weeks. As I mentioned before, please do check out our video that we released on Saturday. You'll see we cover this recovering from a Bitcoin bear dashboard. And it's really trying to help make this super actionable and super bring down all the concepts into simple bite-sized chunks. So you can understand each of the topics, each of the concepts, and find confluence across many of them. So until the next one, I'll see you then. Cheers.